Mark, good to see you again. Thomas, you're new to the crew. Welcome on board. Welcome to your first AP call.
Welcome. There we go. Thank you.
Yeah. Welcome, Thomas.
Yeah, we try to make this interesting and worthwhile, Thomas. So hopefully you get something out of this today.
I've got 1,000 questions, but I'm listening and holding back to see if I can get them answered when I start asking. Because
Yeah. Hey,
Yeah.
Doug, just the only thing I would have for this one, I learned after a call with a broker. The advice he gave me was when you see something, strike.
Yep.
And that has changed a lot of things. A lot of hemming and hawing and double checking the IV calculations and
Yeah.
looking at the zip codes for the growth rates. Just strike.
Yeah, I'm a big fan of moving quickly, and we'll talk about a little bit about, I'd say, it's my personal approach when I'm looking at a deal, and my personal approach may not be appropriate, and it may not be appropriate for some of you. Some of you may want to take advantage of it, but you really, it's really kind of putting you in a position of being a front runner in a deal while reducing your overall risk for buying into the deal. And I'll talk a little bit about that as we kind of get going here. But I mean, it's a trick that I use all the time. And so, it gets me in the game, and then, I can negotiate my way through to ultimately to the end that I want to get to and that I think is fair to the seller. Hopefully we're both on the same, as I walk the seller through the process, hopefully I bring them to the same conclusions as to why I think something is worth something, versus maybe the initial valuation that they gave. But we'll talk a little bit about that as well. You guys want to get started?
Yeah, go ahead if you want to kick it off and kind of lead in.
Yeah, that's fine. Yeah. So Doug wanted to have me on this call today to talk about a little bit about valuation, and I think it's important because I think a lot of people, that's where a lot of times that's where the deal stops. It's the most common reason for a deal falling out at the very beginning of the process is there's just this valuation gap between what the seller thinks their business is worth, or what the brokers told the seller what their business is worth, versus the reality of the marketplace. And I think a lot of you guys that have been around for a while, especially like Gloria, she's been around for a while. I'm sure she's heard me say a number of times on AP calls that, I hate, multiples. I don't believe in them to a certain extent on the buy side. And when I say that, people are like, what? Whenever we're talking about a deal, you're talking about, well, I wouldn't pay more than 3 or 4 times this. Yeah, I use them as a shorthand method for helping you guys get to a, kind of a baseline valuation to start with. But really, multiples, when you look at them, those are really sell side multiples. So it's really kind of brokers and quite frankly, investment bankers. I'll tell you guys right now, investment bankers and brokers are pretty much the same in terms of their laziness with really coming up with valuations. Investment bankers are just higher paid, and it seems like there's more science to what they're putting out there. But I learned early on in the game when I was in IB that it's a game. You can pretty much make up any number and justify it. And so a lot of times what brokers and bankers will do is they basically look at, oh, okay, this type of business was sold at 3 multiples, so I'm going to attach that to the business that I'm selling. So they use comps. They don't really do any hard analysis. And when we used to build pitch books, we basically would take 6 or 7 public companies that were similar to the same company that we were selling at that point in time, are for the most part on the sell side, and we basically find the same, run a bunch of numbers and kind of justify putting the business somewhere in the middle of those 6 comps. So yeah, this is what we're taking this business out to market for. So it's really a sell side multiple, a way to start to garner interest. Now, I say it's sell side because each buyer should be basing the investment decision or the valuation on their own particular inputs. So that's, and when I say inputs, I'm going to keep it very simple right now. When I say inputs, you're going to borrow to buy the business, most likely. You're not going to pay cash for it. If you're going to pay cash for it, then you pay a much lower price for the business anyway. But you're going to borrow money to pay for that. So you have to cover that nut, right? You're probably going to have, you're going to invest equity. If it's your own equity, you're going to have your own expectations of what type of return you want on your equity. Okay. So you need to cover, those are pretty much the two things that you want to cover. So it's your equity costs as well as your borrowing costs plus a margin. Okay. And if you have a partner that's in there as an equity partner, you have to consider, your cost to that particular partner. So, I mean, and every investor may have different inputs. That's why I say from a buy side perspective, my inputs might be different than, Thomas's inputs or Christopher's inputs or what have you. My cost of capital, I deal with a family office when I'm buying a business. So I have a certain cost of capital that's going to be different from someone who's buying a business with an SBA loan, or who has another equity partner. I mean, my equity partners are, require somewhat lower costs for me, just because I've done a number of deals. But at the same time, if you go out there and equity partners are all over the map with their cost requirements, if you go out there and find one, your cost of your inputs are going to be different. So, and along with that, how you assess risks in a business are going to be different. Something might be more risky to Mark that's less risky to me, just because we have different skill sets. So a lot of that feeds into the valuation process. So I just kind of wanted to start that as a jumping off point. Now, ultimately in this game, again, valuation is more art than science. Yeah, we give you spreadsheets, you get these multiples, you get these numbers, and you say, oh, this is what it's worth, this is what I should be paying for it. But ultimately, the only valuation that counts is what the business actually sells for, right? So a business is really only worth what someone is willing to pay for it. So all those calculations, and I read some article, and I was talking to a friend of mine about it. I read some article that Harvard teaches over 100 different valuation methods and how to build 100 plus different valuation models for acquiring a business. And then we kind of all laughed about it because we're like, and they're all wrong, because ultimately it comes down to whatever someone's willing to pay for it is what the business is worth. So you can pull a number out of thin air and basically, I'm going to pay this for it, and if you end up buying it, then that's what the business is worth, right? So one technique, when I'm talking, and we'll kind of get to some more, we'll get into this a little bit more about, some specifics around that business valuation. But one thing, when you guys are out there and you're dealing with brokers and you come up with a certain value, let's just say you put $3 million on a business as the value, and the broker's coming back, and like I said, brokers tend to be pretty lazy with the process, but they come back and they're telling their seller, no, your business is worth $4 million. The first thing I would ask the broker or the seller, if you have direct access to the seller, is how did you come up with the value for your business? And you don't say it in an accusatory tone, but just ask them, how did you come to $4 million? And they're going to say, well, I'm looking right now in the market, the business, businesses like mine are selling for 5 times and you're only willing to pay 3.5 times. Okay, fine. All right. My next question is going to be to the broker and seller, and this is kind of how I get in the game. And maybe I shouldn't be telling my secrets, but no, I'll tell you guys. How I get in the game is the next question I ask the broker or the seller is, okay, so I'm saying your business is worth $3 million. You want $4 million. And the next statement that I just simply make is, let's see how I can get you to your $4 million price. And all of a sudden their ears perk up like, oh, okay, I might be able to get to what I want. Okay. And then my offer would be basically a $4 million offer. Okay. But it's going to be structured in a certain way to make sure that I'm only paying $3 million, but if the business hits certain targets, then I'll pay $4 million. And I've talked to a number of you guys about structuring deals like that. Okay. So that will be the first thing is like, guys put out a pre-LOI or whatever. It's like, hey, I'm willing to pay $4 million based on, what the business comes back as, whether the SE checks out, what the, whatever contingencies I put in the pre-LOI, whatever, subject to, as a terminology I like to use, and I just send it out. And then when we get back, if they're like, yeah, 4 million's okay, he's going to pay 4 million, then I write the formal LOI and I start to build a structure around that. And then, but by then they've got some buy-in. Okay, so we've had that discussion. They know where I stand initially. They told me what they want, and I offer what they want, subject to verification. So they feel like they're going to get what they want, and they will ultimately get what they want if we get to certain targets. And some of those targets going to be depending on the business, the level of business, your confidence in the business. Some of those targets may be so far off the chart that they'll never get there, and I end up paying $3 million for the business. But if we do blow out the business like I would like to, and we have that incentive to do that, they ultimately maybe they get there. So when I bought my manufacturing company, the idea, for us, they wanted, I think it was $12 million for the business. We thought the business was probably worth closer to $8.5, $9 million. So we set up a deal with them and basically we used an earnout structure because we didn't use an SBA loan to buy the business, but we effectively paid them, I think, $6.5 million in cash. Then we put another $2.5 million note on the business, and then on the backside we put an earnout that if we, grew the business over the next 5 years by like 30 or 40%, we pay out an additional $3 million to them. So we're probably about 2 years into that now, and I think we've ended up paying out somewhere around close to about 10.5 million in total. So they're close to getting that 12 million, but we've had to grow the business significantly to get there, and we've shared in that growth with them. So the bottom line is you can get to that price gap. You can close that price gap fairly easy. Again, but it comes back to, these numbers that people think their businesses are worth and that you're calculating, it's really all made up. I mean, it's just kind of what you really want to pay for it. And again, you just have to take some costs into consideration, plus a margin over and above that. And honestly, if you're good at just being mediocre at forecasting and just assuming no growth in your business, and then you build your valuation around that, the chances of you going wrong are a lot less than if you build a model out there where you're growing at 20% and then you're assuming that that's going to cover your costs and you're willing to pay for that growth now or whatever. I never do that with these types of businesses. Maybe if it's like a stable business with a management team in place, it's kind of growing, it's already at about 20 million bucks or something in revenue. Those types of businesses you can really blow out. And I know I'm a little bit all over the board here, but it's just like I want to make sure you guys understand my perspective on valuation is that it's not as crucial as you guys think it is, except that you want to make sure you don't overpay, but you also want to make sure I wouldn't nickel and dime, a few $1,000s here, a few $1,000s there, because ultimately it doesn't matter in the wash as long as you can cover those costs. Could someone please mute their mic? I hear some...
This is Kat.
Okay. Oh, all right. So she muted. All right. So let's talk about the four most common valuation methods and why you would want to use one versus the other. And maybe not even why you would want to use one or the other, but I just want you guys to be aware of kind of how we look at these things and how maybe some brokers look at these things. And then you can kind of find a way to, kind of push back. So obviously the most common one is the EBITDA SDE multiple. It's the most common that we use. It's kind of what we teach you guys. It's simple, but again, you guys have to understand it's subject to manipulation. So whenever you get these SIMs back and they tell you this is the SDE, you look at the broker add backs, and some of you guys have found this. Some of them are legitimate. Some of them, we're adding back marketing costs because we did this marketing campaign one time and it didn't work out. Well, so what? Just because you did something stupid, you don't get the benefit of that. So the SDE multiples and all that stuff, they're subject to manipulation, but it is a simple way of calculating kind of what a business is worth. Now, those multiples, again, we get back to this. Those are still sell-side multiples. You have to figure out, plug those multiples into your models, your SBA calculators, to see if purchasing the business based on your costs of financing, based on costs that you need in the business, based on your cost of equity, if that multiple makes sense. If it does, great. If it doesn't, don't do it. I don't care what the multiple says. So if your SBA loan is 15%, let's just say, and I'm being extreme, well, does it make sense to buy a business at a 4 or 5 multiple? No, you're not going to be able to cover your loan costs. I don't care what the market is pricing the business at. Now, markets should adjust to those interest rate costs, but sometimes they don't. And sellers are unrealistic. So be quantitative in your initial analysis, but you can accept, don't just say, because HVAC companies are selling at 3.5 times, I'm going to pay 3.5 times. No, you should really figure out the numbers beforehand. Don't just try to, oh, that's a fair price, 3.5 times. It doesn't work that way, because again, your inputs could be different. Now, if the standard input generates, if you come out at 3.5, if you put it in there and 3.5 works, fine. But if your cost of debt is a lot higher than someone else's, then maybe your multiple that you should be paying is 3 or 2.5. So you have to think through those kinds of issues when you're looking at that particular model, valuation model. Then we have what's called a yield on capital model. I'm not even going to go into that. It's just basically the inverse of the multiple model. It's like, if you're thinking real estate, think cap rates. If I buy this real estate, what's my return on capital? 4% cap rate. So it's just the inverse of the multiple. I would say the most sound way of doing these, but I don't think you guys need to go through this exercise, is using a DCF model, a discounted cash flow model. I only say that because if you can get the inputs right, then your valuation could come in above the multiple, could come in below the multiple, but it's the right fit for you in your particular circumstances. But there's some assumptions you have to get right if you're using a discounted cash flow model. And I'm not going to go into the particulars of how to build one. I mean, you guys can go pull out a finance text and learn how to do that. There's some nuance to it, but that's probably the most sound way of looking at a business in terms of valuing a business. But you also have to know how long you're planning on holding the business, what your exit is going to be. You really have to define your goals. But if you have all that laid out, it's probably the most sound way of doing this thing. And then you don't care what the multiple is at that point. So I actually at one time I bought a business that was selling, and my partner thought I was crazy. It was it was like a not an online publishing business, but it was like almost like a book business, like a publishing business. And it was a small printing company. And the idea was that, the printing companies at the time were selling, for small private printing companies, I think were selling for like maybe 4x multiples. And then when I did my analysis, my own discounted cash flow analysis, it came out at 8. Ultimately, the price that I was willing to pay was about at an 8 multiple. And my partner looked at me like, what? These things are selling for 4. I'm like, yeah, but based on what we plan on doing in this business, let's just blow it out the doors, and we'll just buy this thing at an 8 multiple. And we put the offer in, and we got it. Okay. Then we ended up buying the business, and then we found out there were some problems in the business. It was one of my losers, and we ended up selling it, and we lost like 20% like a year later on it. But we got out of it while we could. But the idea was sound though, from the standpoint of, I used a DCF to value it, which was way off the broker's radar. In terms of the price, they were way underpriced, or what the market was pricing these things at was way underpriced. This was like a private deal. It wasn't even on market. We actually just cold called the guy to buy the business. And then there's what we call a barrier to entry valuation, which is basically if you find a business that, and I learned this in private equity when we were buying distressed assets. If you find a business, it's in trouble, it's losing money, then basically let's do a barrier to entry valuation, which is basically a replacement cost. How much would it cost us to get into this market with everything that this business has going for it, people, systems, processes, even though they're losing money, assets, how much would it cost us to replicate this business? Okay. And, because you can't value a negative cash flow, right? So we use a kind of a replacement cost valuation to figure out kind of what that value looks like. So there's a whole lot of different, these are just 4 common methods of valuing businesses. And this is why I kind of go back to what we're talking about is, Harvard teaches over 100 different business valuation models. So which one is right? And my answer would be, not one of them is right, but all of them are right. Okay. So valuation is an art. And you just have to understand kind of what goes into one, what you feel comfortable with, what you can afford, what your lender is, saying from their perspective, what they're willing to lend against it, how much equity you can put into the deal, what your equity partners' cost of capital is. And then there's a whole lot of risks over and beyond that that you need to consider. And so when I say that, what can push a valuation up or down, once you figure out kind of quantitatively where it is, if your business has contracted or recurring revenue, that reduces the risk in the business, so that increases the value. Multiple products or services that the business offers increases the value of the business because it reduces the risk. You've got a business that's in multiple geographic markets. You're not tied to one market. Okay, that increases the value. That can push up the valuation from your quantitative analysis as well. Very customer base. We always talk about customer concentration. So if you have a very customer base, that increases the value of the business, pushes up the value of it. And then the other two aren't, I would say, aren't important, but they're important for looking at the future of where your business can go in terms of its value. But right now, the businesses you guys are looking at probably not as important. But if the business has scale, and that's a huge reduction of risk for a business buyer. And when I say scale just means the business is big enough to pitch for bigger jobs, contracts, or services from larger customers. And that business tends to be kind of higher margin business. And then it's also able to take advantage of like cost savings from vendors because of its purchasing power. So when you get to scale, that all of a sudden your multiple goes from, let's just say 3 to 10. Okay. That's a bit of risk reduction strategy, obviously, but you're not going to have scale if you're buying these SMEs right off the bat. You want to build scale into your business. And that really starts at about, like I said, $100 million. That's where you get PE coming in and bidding up valuations that are crazy. And then there's also what we call a liquidity value, liquidity risk. If the business is, you think of it this way: if you have a small business that's a private business and a small business that's a public market or publicly traded business, they're the same size, and there are some small businesses that are publicly traded, believe it or not. The one that's publicly traded is probably going to have a multiple 3 or 4 times the size of the one that's privately traded because of liquidity. It's easy to get in and out of the shares of the business, so they call it a liquidity discount. So don't ever let a broker tell you, well, we're selling this plumbing company at 5 times because there's this public plumbing company that's selling at 7 times or whatever, or 5 times or whatever. It's just like, so what? I can't sell my shares, buy or sell shares easily in this private company like I could the public company. So there's always a haircut you have to take as a private company from that standpoint. So all that being said, I've talked my ear off here. My whole point about valuation is it's very buyer centric from your side of it. There's a little bit of math, a little bit of what I wouldn't even call it science on the sell side, but it's more or less looking at comps, basically dropping them in there somewhere in there on the sell side. But again, as a buyer, you have to be very specific to your own valuation. It's kind of like Warren Buffett says. Warren Buffett doesn't necessarily care what the stock market prices businesses at. He's looking at his intrinsic value. His intrinsic value may not be the same as somebody give me another investor out there that's, I don't know, whoever. I should know this. Let's just say the guy who runs, I don't know, whatever, Elliott Management Company. You guys don't care about that stuff. But anyway, Warren Buffett always talks about his intrinsic value. This is what I'm willing to pay. This is what I value the business on, which may be different than the next investor. I don't care what the stock market says it's worth. I don't care what the broker says it's worth. This is my calculation of my intrinsic value. And really what Warren Buffett is doing is he's going through and looking at all of these different risks that he sees as a risk for him if he buys it, which may not be a risk for, let's just say, Jeff Bezos if he was an investor, or Bill Gates if they were investing in the company. Warren Buffett doesn't know anything about technology, but Gates and Bezos does. So maybe that's not as risky to them, so they're willing to pay more. So you really have to understand kind of your strengths and weaknesses when it comes to evaluation. in addition to the quantitative analysis that you guys are doing as far as putting them through spreadsheets and figuring out, here's my cost of capital and what have you, this is what I'm assuming I'm going to do over the business over the next 5 years. You've got to build all this other stuff into that valuation, which is why I call it the dark art of valuation. There's no easy way. There's no like what I call, magic formula that's going to give you about the same valuation all the time, and that's going to ensure that you're not overpaying or underpaying. You just have to assess all those different risks, and you have to come to some conclusion in your head as to, where do you think you're going, what do you think the exit looks like. And really, I think a lot of people don't consider your timeline for holding, and they don't consider the timeline of what they want to look like, what they want to look like on the exit, because that can also dictate the price that you're willing to pay up front as well. So all that being said, let's talk about your valuation questions. There are some specifics that I think we can get to as far as you guys wanting to understand a little bit more about it. So and again, I think the spreadsheets at Acquira do a good job of giving you a baseline, but I think you got to be careful that you can't use them without thinking through the assumptions that are on a spreadsheet. For instance, the intrinsic value calculator, it's a great tool to start with, but like if you put a number in there for the trailing 12-month number, okay, and your assumption about that 12-month number is off, your complete valuation is going to be shattered. Okay, so a lot of times if you take a trailing 12-month number and it's the true trailing 12-month number, that's fine. But you got to consider, is that trailing 12-month number a number that's a sustainable number moving forward? Okay. If it's not, if it's a one-time trailing 12-month number, let's just say you've got a plumbing construction company. They had a great year, or they're having a great year before the end of the year, and their trailing 12-month number says that they're doing, I don't know, let's just say it's $5 million in SDE. Okay. All right. Now, in the previous, they've never done more than $2 or $3 million. Okay. But you plug that $5 million in there as a trailing 12-month number, and then all of a sudden your valuation calculation comes out to, and I'm going to be extreme again. It comes out to like $20 million, just because you put in a trailing 12-month number of 5 million. You got to think to yourself, well, that valuation and that price might make sense if 5 million is the number going forward every single year or more. But if that was a one-time hit, they had a one-time project, and then next year they're back down to 3 million, you've now overpaid for the business based on your commitment to the tool without necessarily thinking through the numbers that you're plugging into the tool. You guys get what I'm saying? I mean,
well, let me jump in there, Rich, and I want to tie it to Mark's original comment that he got from the broker. Like, if you see an opportunity, jump on it.
Yep.
And I think that's the delicate tipping point that we all should be sensitive to when you find these deals, particularly the on-market deals, because the good ones go fast, and you can overanalyze, even invoke kind of a analysis paralysis in being able to get an LOI out there, only to find that the deal got gobbled up. There were 5 other offers, and the seller's tired. He doesn't want to entertain anymore. And what I think we're trying to get across is the idea that running the numbers is good and definitely should be done, else we wouldn't have those models in our material. But you need to move quickly from your first pass at the numbers into this more subjective evaluation of risk and your own mindset and opinion of the deal, and get a number together and put it out in that LOI. And that way you've got some logic in your proposed offer, and you're not strung out and leaving yourself open to just be left in the dust on the deal.
Yeah, I totally agree with that. And probably the best, really, I mean, and if I'm addressing like Mark and he's like, well, I need to get a deal on the table. One trick that it's not even a trick, and I kind of talked about it at the beginning, is, if someone, well, I'll put it this way. If someone comes in, if the broker says, all right, we want $4 million for the deal, one thing I would do you know, if you've really got to get a deal out on the table and you want to be kind of in the game and you don't want to seem like you're being flippant about offering a deal, because sometimes a broker will throw a number out there and then all of a sudden you respond and you're willing to pay that number right off the bat. It may not be a real number, but they want to see if you're like a real player. Okay. So are you being serious or not? So one thing I would do is take the broker's numbers, take that information that you're getting. I mean, you don't even need a whole lot of information. And when I'm saying assessing risks and valuing the business, I'm really talking about I would say post acceptance of your initial offer, because you're going to start getting more information in which to base a real valuation on. But before that, I would say they throw a number out there and it looks reasonable, don't offer the full amount. So I would say, you know, like for Mark, if they're saying, look, I want to sell this business for 5 million. If the price looks like it's not like 10 times whatever, you know, and it looks like it's somewhat reasonable, then I'd take the strategy of offering like 5 to 10% less and say, yeah, look, I tell you what, because it looks like now I'm really negotiating. So I'll say, look, I'm interested in this business. Would you guys be interested in a $4.5 million offer, which is basically, you know, a 10% reduction or whatever. I mean, you can do it 5% or whatever. But I say, are you guys, interested in a $4.75 million offer? And if they say yes, I put together an offer and get it on the table and get it accepted. And then once they come back, you're not necessarily retrading the price, but now you're going to be in a position of, okay, this is really kind of what the structure needs to look like based on the information that you've sent me. So it allows you to move kind of quickly and makes your offer look real. You know, I've seen brokers put a outrageous number out there, and I've seen people actually, PE firms are known to do this, especially at the higher end of the market. They throw a number out there. We're selling this business for $100 million. And, you know, everybody and their mother knows the business is probably only worth 50 million. But there's a PE firm that comes out there. Yeah, we're going to put an offer in 100 million. And brokers have become wise to, yeah, they're putting $100 million in there so they can lock it up and then retrade the price later. Okay. You don't want to get that reputation. That's why I say look at the reasonableness of the price. Maybe plug it into one of those calculators real quick just to see if it looks like it's okay. And then just offer at the price or close to the price or just below the price so that, you know, you look like you put some thought into the offer. And if you do that, you're going to be in the game right off the bat every single time. And then maybe there is someone else that you're competing against, but you're going to start to get the information. You'll start to be able to build rapport with the seller or the seller's broker. And then sometimes if you build enough rapport with that broker, because usually there's going to be brokers involved. You guys aren't doing like a lot of off-market deals, but if you start to build a good rapport with that broker, sometimes that broker is going to be willing to take a little bit less if they think that you're believable and being able to execute on the deal. You're a nice guy. They think that you and the seller will mix well. They don't think you're going to destroy the company, or they've intimated that the seller doesn't want you, dismantling the company. If you can get all those lined up, you may be able to get the business for less than the person you're competing against. Not significantly less, because the broker still has to make his money. And he's going to make sure he pushes on that end. But at the same time, you've kind of gotten in and maybe, a couple $100,000, so that seller doesn't matter. As long as you kind of meet that criteria. But that's a quick way to get into the game and take quick action. Use the intrinsic value calculator, but just make sure you're throwing in a reasonable assumption around it. And like I said, I would always weight those numbers that you're getting and use that as kind of as your starting point. Don't just take the trailing 12-month number and assume that's, unless you think that is the number going forward. But I don't know that you have enough information to start with to go that way. But just take a weighted average, get to see what the number is reasonable given the price that they want, and then just go from there.
So anybody got any questions or comments they'd like to share? Quinn, go ahead.
Yeah, one of the biggest challenges I have is when companies don't have an asking price listed. So we'd love to have some insights on how you land on something that's reasonable when that's not present.
Yeah. So in this case, when I said I hate multiples.
Yeah.
Yeah. In this case, I would actually research. You can do this fairly easy on the internet. I mean, you can just basically type in what are XYZ type of companies selling for or whatever. And I would kind of use that as a reasonable guess multiple. And then I'd actually compare that to what's in the intrinsic value calculator. So sometimes if we don't update those calculators, the multiples could be off. That's why I said I would probably do you can find the multiples. You can go to Biz Buy Sell. They actually have a multiple, like a report for what businesses have sold for over the last, quarter or whatever in my industry. But, and I use that as my base case. And then I would probably, like I said, I'd probably use a weighted average on kind of what they report as the SDE. Don't even worry about doing your own analysis of add backs and all that stuff. That comes later. Use their numbers, because then you can explain their value, your valuation, initial valuation, by pointing to their numbers in their SIM. So use their SDE numbers, and then I weighted average, and then use that multiple, and then I start there as kind of like my base valuation of probably where they want to be, and then I would run my numbers through your SBA calculator to figure out, okay, does it make sense at this multiple? Can I cover my nut? What's the debt service coverage on that? What's my return on that over the next 5 years? Am I getting what I want out of this business? Can I pull enough cash out of the business? And your SBA calculator should do all that stuff for you. And then I put in an offer in, there if it makes sense, and see what kind of response you get back.
Okay, thanks.
Yep. Any other questions?
Kelly, had you had something earlier?
Yeah. Sorry about the noise. I was in the. But yes. Can you talk more about? You were talking about don't do evaluation based on growth rate, but then what's more appropriate at this level? And do the calculator? I think the Acquira calculator assumes like a 10% drop and then 10% growth year over year.
Yeah.
What's your point of view on that? Yeah.
Yeah.
Sorry, go ahead.
No problem. When I say that, I'm saying don't pay for what the broker sells as growth. And when I say that is sometimes they'll price these things based on some growth trajectory of the business. A lot of times you see it in like tech valuations, okay? But you'll see some brokers try to do it with like service companies as well. Sorry if my phone's ringing across the room and I can't get through it. But what you'll see is they'll say, well, this company's growing at 25% per year. If you do this, this, and this is what this company's going to be worth. And so we want to sell it at, a valuation based on that growth. My whole point is that, look, if I do this, this, and this, it's going to cost me money, and you didn't do this, this, and this. So why am I going to pay for what you didn't do? So that's what I mean by paying for growth. Now, if they've shown some growth, and like I said, if I'm looking at the broker's numbers and their SDE is growing pretty well, that's why I said I would use a weighted average calculation on the SDE, because that's going to be that will reflect in the valuation and the price that I'm willing to pay. So let's just say, in 2022, they were doing $1 million in SDE. Okay. And in 2023, they did $1.5 million in SDE. And in 2024, they did $2 million in SDE. Okay. So what I would simply do is say, okay, I'm going to give them credit for growth, but I'm going to do it this way. I'm not going to give them credit for future growth beyond this. I'm going to give them credit for their historical growth. I'm going to put a 60% weight on that 2 million. I'm going to put a 30% weight on that 1.5 million. And maybe I'll put a 10% weight on that 1 million. So now they're, I got like a number that makes sense. I'm rewarding them for that. But when I look at that number, that makes sense in context of what they've done in the business versus what they plan to do down the road. So that's what I'm saying I distinguish from growth. Now, tech companies are completely different. And that's why I said, when a VC is buying into a tech company, the reason they pay astronomical sums for a business that's not making any money is because there's an inherent growth that they think is going to happen in the future, and they're willing to take that risk and fund that growth. So it's a little bit different. You're paying for kind of what they've done and you're rewarding them for it, but anything beyond that, you're kind of like a broker convinces you like, well, it's going to grow 25% next year and the year after that, and so we want to realize that, we want to realize some premium for that, and you're like, well, wait a minute, you're not doing that. How do you know it's going to grow that? Are you going to be involved with it? And if that is the case, then why don't we just roll over? Why don't you roll over some equity in the business and take that risk, because I got to pay for that. So that's what I mean by not funding growth. Yeah, pay for the growth that they've had to a certain extent, but don't pay for the growth that they're talking about, the broker's trying to sell you on, that you can do this, this, and this. Well, you didn't do this and this, so I got to pay for it. So I'm not going to pay you for it now. I'm not going to pay you a premium for that.
Got ya. Thank you.
Yep. Anything else? I can talk about this all day, guys. This is one of my favorite topics because it's so opaque, and you can play around with numbers. And I love playing around with numbers, and I love playing around with assumptions, and so I can talk about.
Looper, go ahead. You had a question. Oh, sounds like we lost him.
But
What do you think about those tools like Biz Equity and the software tools that like planners and analysts use?
No, I think those are fine. But again, and when you look at those, a lot of those tools will use a DCF model, a discounted cash flow model, to help formulate some sort of valuation. And I love the DCF model. It's just that, your inputs, you got to understand your inputs that are going into that model, and you have to have kind of what I call not a long-term vision, but you better have a vision for when you plan on terminating the business or refinancing it or whatever, some sort of exit event, and kind of what that exit event looks like in terms of, a future multiple, so to speak. So, I mean, as long as you can get all those assumptions right, I think they're great tools. You just have to, make sure you understand how to use them effectively and you have the right data going into them. But I think it's the most sound method of actually valuing a business because it incorporates all of those assumptions that we talked about, not only the numbers, but also the inherent assumptions around, contracts, markets, and all, and customers and operations, all those risks. You can build that into one single, basically, risk metric, discount tool. The discount metric is what I'm trying to say, or discount rate. So I like those tools.
Awesome. Hey Doug, can you guys hear me?
Yeah, there you are. We lost you
Awesome.
a minute ago.
Yeah, no worries. Hey Rich, so when it comes to I think based on you talked earlier about doing like a weighted average for the seller discretionary earnings for the past 3 to 5 years, right? Because sometimes you come across businesses where it's like, didn't do so great in 2021, was okay in 2023, and then 2022, and 2023 was like this massive year, and then you see the broker using just 2023 to set the 3 or 3.5 multiple.
Yep.
And you're like, this is bullshit, because like there's no way like this company all of a sudden had one good year, and like they may go back to like 2019 when they had a really crappy year.
Yep. And that's exactly why you want to use some sort of average. You could use a straight average, you could use a weighted average. It just depends on kind of what what you believe about the business. And I totally agree with you. And actually, that's been a problem for a couple of deals that we've had come through. It's just like, the broker, they have one great blowout year. Yeah. And then all of a sudden and the broker values the business on that. And then all of a sudden you're halfway through the year, you get the 6-month numbers and the business has fallen off a cliff. And you're just like, oh, okay. I now know why you wanted to sell the business.
Yeah.
And why has it fallen off of a cliff? And for one deal, and we won't mention any names, but one deal they told us, it's because of the elections. I'm like, what? They're like, yeah, okay. Sure. So, you're absolutely right. Brokers will try to take the number that makes the business look the best and then base it off of that. And even if it's like the 2022 numbers and we're now in 2024, they'll try to say, well, 2023 wasn't, they had some issues. A kid got sick, or, the sales guy had to take some time off. but he's coming back. So the numbers should normalize back out to 2022, even though in 2023 and 2024, the numbers have basically dropped in half. They'll try to justify their value, obviously. And I mean, it's their job. They're trying to get as much money as they can for their seller. So I get it, but at the same time, you just have to be careful and you have to be cognizant of that fact, which is why I think smoothing out those numbers makes a lot of sense. And however way you want to smooth them out to benefit you makes the most sense.
Yeah. Greg, you had a question?
Makes sense.
Yeah, I'm just curious if you have any favorite intangible qualities that you look at in valuations, whether that's, culture, employee tenure, brand strength, Google reviews, social media followers, like anything like that. And if so, how do you factor those into your evaluations?
Yeah, I mean, all of those are important. Now, so there's two, you got to understand kind of where you are in the context of the deal, okay? And how much information you've gotten from the broker. Some brokers will provide a whole lot of information. Most don't. So sometimes, if you got to get a deal out there, you got to get an offer out there, you're probably not going to have enough time to do significant research there unless you just quickly go to the internet to find, some of these intangibles, but you're not going to understand who the management team is unless the brokers talk to you about it, provided you with an org chart or something like that. So sometimes when you're trying to get a deal on the table, it's going to be more, you're going to kind of discount a lot of those, not discount them, but you're not going to really consider them early in the process. Now, as you get through the process, all of them are important. Some more than others, given, if you're a business to business, let's just say your customers are primarily other businesses, then Google reviews aren't that important. I mean, because no other business owners out there really, they're not really going to be doing Google reviews. They don't have time to run their businesses. So you're not going to see a whole lot of Google reviews from that standpoint. Whereas if you're a consumer facing business or a residential customer, or home residential, you're providing home residential services or something like that, then that becomes a lot more important from a, reputation standpoint in terms of measuring reputation. But, I think all of them are important. How I would incorporate, I don't have any favorites. I mean, the most important to me, and when I'm looking at a business, most important is the team that's in the business. Do they have, because the business is transferring. So you want to make sure, if the business is transferring, am I buying a team or am I buying a job? Okay. So, because that's going to hugely affect the value that I'm willing to pay. Because if I'm buying a job, then all of a sudden I've got to put money into finding a team and I've got to work there, and it takes time, and time is money for me. So my value in that business is going to be a lot lower than if that business has a team. So for me, team number one is probably the most important thing when I'm looking at it from an intangible standpoint. The other areas I'm looking at are going to be from I would say a customer standpoint, the types of customers that they're selling to. That's important to me because there's some businesses I don't want to deal with certain types of customers, so that's important to me, but it might not be important to you. So weighting all that stuff, you have to decide kind of what's important to you. And a lot of this goes back to your skill set as well. If your skill set is you have certain skills that I don't have, some of these intangibles are going to be more important to you than they are to me, and vice versa. So once you've weighted all that just gets weighted into kind of the multiple. You're making small multiple adjustments along the way. Maybe instead of, if the business has a lot of intangibles that you like, and maybe, you started off at a multiple, let's just say 3, and all of a sudden you've got all these intangibles that make this business great. They've got a great management team, a great marketing system. They've got great customers. They're selling into multiple markets. They've got great expansion, capabilities. So you're really looking at kind of like what the future might hold if you buy the business. And if I'm looking at what the future might hold, maybe I'm willing to pay, instead of a 3 multiple on this, maybe this is worth a 3.5 multiple. Maybe this is worth a 4 multiple. Okay. So you just have to kind of, it's almost like, it's not like a guess. It's a gray area, but you've got to get to a good feeling about that. And that's why I say, building a discounted cash flow model is probably the best way of doing this, because you can then build in kind of that growth and what you expect to do in the business, and actually build it into a quantified model that you can then use to kind of come to a price from that standpoint. But yeah, I think all of it, to answer your question, the long answer to your short question, all of those intangibles are important when you're looking at them. Some are just more important to some buyers than others, which again all ties back to your valuation that you're doing should be more of a personal valuation based on what you think the business is worth, not based on what some broker is telling you what the business is worth or some general market multiple.
Yeah, cool. Thanks. Yeah, for just some additional quick context, I think a lot of things that I find are when I plug deals into the intrinsic value calculator, I end up, getting a result that says, only do the deal if it's 10% below this value. But I do have enough information to actually conclude on a lot of these intangibles, and I focus on that quite heavily.
Yeah.
And I'm kind of only looking at the good businesses that have those strong intangibles in the first place, and therefore it allows me to adjust even within that intrinsic value calculator, like the full screening pass to get the valuation up to basically their asking price. So
yeah, and that's the perfect way to use that calculator, because the initial calculator is just a first pass look, and then as you get more and more information, you incorporate it into it, and you're using it the perfect way. You're gathering enough information to then go back and adjust the calculator, see what the true value is to you based on the information that you know. So yeah, you're using that perfectly.
Thank you.
Yep.
All right, guys, we're about up on time. One last round real fast. Does anybody have any last quick questions we could handle for you today?
This is one of the rare times you guys got me for free time for an hour. Better make use of it. You know how my calendar is.
All right. Well, thanks everyone for sitting in. Appreciate your time. We will get this posted to the archive as always. And with that, we're going to sign off. Have a great weekend. Look forward to talking again soon.
Great call.
See you guys soon.
Bye.
Bye.